Welcome everyone to Vested Interest. This is Shane, and today's video we're going to take a look at 4 stocks at or near 52-week lows that might be in the buy range. Could be a huge opportunity you don't want to miss out on. But before we get into the video, if you would take a moment to help me out, hit that thumbs up button down below if you find any value in the content. Hit that subscribe button. Join us on this journey to financial freedom. Join the Vested Interest community. Hit that notification bell so you're notified whenever we put out any new content. Share the video with anyone you think that might find value. We are dividend growth investors here on this channel. That's what I cover. So if you know any dividend growth investors or investors in general, share it with them if you think that they might find value. And drop a comment down below. Let me know what you're investing in, what is going on in your portfolio. A lot of green in the market right now. Hopefully your portfolio is showing some green as well. Are you buying anything? Are you selling anything? Taking profits possibly? And doing all that, again, hit that thumbs up, hit that subscribe button, hit that notification bell. It really does help out a small YouTube channel like me with the YouTube algorithm. So really do appreciate it for everyone out there who has done that. And really thank you so much to all of you who have subscribed to the channel. It is greatly appreciated. Let's jump right in the video here. So we're going to start out with American States Water Company, ticker AWR. This is a utility company here, and we're going to look at a little bit of their numbers. They closed out the trading week here on March 28th at $72.24. You can see here market cap of $2.67 billion, so they are a small cap company. Revenue of $595.7 million. Now, we won't really run through everything. Earnings per share sitting at $3.36 per share. Price to earnings ratio, PE ratio at $21.50 currently. Looks like their forward PE is slightly higher at $23.74 per share. Dividend is $1.72. They are a quarterly payer, so divide by 4, but we'll see that here on the next slide, what their most recent payout was. Starting dividend yield at 2.38% if you were to buy them now. Ex-dividend date February 16th, 2024. Looks like they paid out on March 1st. So if you bought them now, you would be in line for the next dividend, but you're going to be waiting a little bit to get that. All right, 3 months from now, you'll get the next dividend if they paid out on March. That would be their next payout. So 52-week range as low as $69.98, as high as $95.08. They are very close to their 52-week low. That's part of the reason we're taking a look at them. That's why this video is called, 52-week lows. We're looking for companies at or near their 52-week low. A beta of 0.42, so they are less volatile than the overall market. That's what beta means. Beta being the volatility of the market, 1 being the market, anything under 1 being less volatile, anything over 1 being more volatile. Now, the analysts actually call this one a sell, which doesn't really make sense to me right now because they have a price target of $82.50 with a potential of 14.2% upside. So unless they're not real, don't have a lot of strong conviction on their price target, I don't understand why they're calling this a sell, but that's just what they're calling it. Next earnings date coming up May 8th. So if you're interested in that, tune in here in, we're about to turn the calendar over to April, so about a month away for their next earnings date. Now we're going to take a look at dividend yield theory. To do that, we look at their 5-year dividend yield average of 1.67. We compare it to its current, right, 2.38%. And since it is higher, that speaks to some undervaluation, at least according to dividend yield theory. Payout ratio is low on this one, 49.26%. So lots of room to increase that dividend over time, pay down debt, make acquisitions, reinvest back into the company. Lots of free cash flow available on this one. Return on equity and return on invested capital, I typically like 10% or better. So this one has return on equity of 16.5%, which is very good for a utility company. Return on invested capital, a little lower than 10% I'm looking for at 8.71%, but not egregiously so. And you'll find with utility companies, typically that is the case with a low return on invested capital. They are very capital intensive. They are reinvesting back into the company, upgrading utility lines, in this case, water lines. Companies like that are always returning their capital back in to do projects like that or expanding out their coverage. You might have a new community that pops up, thousands of houses or hundreds of houses that they have to bring new lines into. So they have to reinvest their capital quite a bit. So typically that is not a terrible number there at 8.71%, and it's hard to find above 10% return on invested capital. So I'm not disappointed in that. That's acceptable in my opinion. Now we're going to take a look at free cash flow here real quick. We want growing free cash flow over time because we want growing dividends over time. And there's several things that a company can do with free cash flow. They can pay down debt, they can make acquisitions, reinvest back into the company, buy back shares, and pay dividends, right? As dividend growth investors, we want those dividends and we want growing free cash flow so our dividends are safe and they can increase them over time. Now, 20 here, they were at 8.2 million. 2021 up to 28, I'm sorry, negative 8.2 million, negative 28 million. 2022 negative 48 million, 2023 negative 120 million. So they're going the wrong way in free cash flow. That is one of the downsides in this particular company, but you will again find this in a lot of utility companies, very capital intensive, and then they reinvest that capital excuse me, back into expanding their reach or upgrading and updating their current pipes, in this case being a water company, wastewater treatment plants, whatever they're doing with that capital. So this is not unusual, though it is something to watch, right? You don't want to be too cash flow heavy. With them saying they have a payout ratio of 49.26, that tells me they have a lot of room in there, and a lot of this might be their reinvestments, and they do write down some of those reinvestments. So there's a way they get some of those funds back. Now they are repaying debt. You can see that here. It's nice to see a company repaying debt, but you really want to compare the repayment of debt to the issuance of debt. If they're issuing more debt than they're repaying, it could be that, yes, they're repaying debt, but they're taking more debt on every year as they issue more debt. So you need to compare the two. So we're going to look at some additional information from stockanalysis.com. And if I didn't mention on the previous page, the information was brought to you by stockanalysis.com and Yahoo Finance. I'm not affiliated with either site. They're just two sites that I go to for information. And I do recommend you pick more than one site so that you can make sure the information you are getting is accurate and up to date. So as you can see here, short of a few years, their revenue is nice up and to the right, which is what you want to see, right? You're going to have a couple down years there, a few down years from 2016 to 2018. Not a big dip there, but overall from 2014 to 2023, over a 10-year period, nice and up to the right in revenue. Nice to see. Same thing with profit margins. Yeah, you're going to have a few years that are down here and there, but overall from 2014 to 2023, up and to the right, currently sitting at 20.97%, revenue sitting at 595.7 million, and AWR's EBITDA, which stands for, if you're not familiar, earnings before interest, taxes, depreciation, and amortization. It helps evaluate a business's core profitability, so that's what we're looking at here. And same thing, overall, I mean, you see a little bit of cyclicality in here, but overall from 2014 to 2023 up and to the right. So very good numbers overall. Now, again, we're going to repeat some of the information we saw on the previous, but this one also gives us a little bit more data. Yield of 2.38%, annual dividend $1.72, ex-dividend date was February 16th. They are a quarterly payer, payout ratio 51.19. So again, I like 75% or better. This is much lower than what I'm looking for. Dividend growth, nice dividend growth on this one, 8.35%, 70 years of growing that dividend. So not only are they growing it pretty quickly, high single digits, 8.35%, they've been doing so for 70 years. Buyback yield is a little low, so they're not buying back a lot of shares here. Actually, it's negative, so it doesn't look like they may be actually diluting you a little bit as a shareholder. 0.1% wouldn't be egregious, though. And shareholder yield of 2.28%. Their last dividend payout was February 16th, and it was 43 cents per share. So that's AWR, again, out of the utility sector. Let's keep rolling here. Next up is Starbucks, ticker SUBX. They closed out the day, end of March 28th there, $91.38. Market cap of $103.47 billion. So they are a large cap company. Revenue of $36.69 billion currently. Net income $4.29. Shares outstanding. Again, that doesn't mean much unless you compare it to, are they diluting you or are they buying back shares? Excuse me, or are they keeping it the same? Earnings per share, $3.74 per share. Price to earnings ratio, a little high in my liking, $24.44 per share. But their forward PE is lower than that at 21.25. That's pretty close to the market. I think the market right now is around 23, which is elevated. I usually like price to earnings down, unless it's a fast-growing company. I like PEs for well-established companies, and Starbucks is a pretty well-established company. I mean, it's been around since the 70s, I believe, 60s or 70s. So they've been around for a while. I like PEs and price to earnings ratio around the 15 range. Dividend at $2.28 per year, right? So they are a quarterly payer. We'll see that here in a little bit. Nice starting dividend yield of 2.5%. Ex-dividend date was May 16th, or is coming up May 16th. They must have already paid out their dividend for the first quarter here. So it looks like they're going to pay out on May 31st. So May 16th for the next ex-dividend date. You want to buy it the day before, 5/15, so May 15th, to get that May 31st dividend. 52-week range as low as $89.21, as high as $115.48. Again, right up against their 52-week low, just above it. A beta of 0.98, so they are just slightly less volatile than the overall market. Now, the analysts call this one a buy. They have a price target of $112.70 with a potential of 23.32% upside. Earnings date, end of April 30th here. Same thing, we're going to look at dividend yield theory. 5-year dividend yield average, $1.94 here, or 1.94%. 1.94%. That's what I should have said. Forward annual dividend yield at 2.5%. So since it is higher, another one that speaks to undervaluation, at least according to dividend yield theory. Payout ratio under 60%, 57.75. So under the 75% I look at. Now return on equity on this one is negative, 51.30. Now they are still buying up locations, so building out new stores, and I'm assuming that is why we're seeing a return on equity in the negative, 51.3%. I don't like to see that, but the return on invested capital is very good at 27.87. So looks like they're using some money potentially to, build out more stores, which is good. You want a company expanding, but I don't like to see negative numbers there. But the return on invested capital is very good. Now we're going to look at free cash flow again on this one. Going back to 2020, 114 million. Big jump up in 2021 to 4.5 billion. Bit of a drop in 2022 to 2.5 billion, and 2023 back to the growth of 9.6. But you can see they are repurchasing their own shares as well. 1.6 million shares here in 2020. Nothing in 2021. But a lot of that drop, if not all of that drop in free cash flow from 2021 to 2022 can be accounted for in this repurchase of shares here, 4 million. And same thing, a nice tranche of shares repurchased in 2023. We'll see if they continue that through 2024. Overall, growing free cash flow from 2020 to 2023 anyway. Again, brought to you from stockanalysis.com and Yahoo Finance. Not affiliated, just two sources that I like. Make sure you're picking more than one source so you can make sure the information you're getting is accurate and up to date. Now, here we're going to take a look at Starbucks revenue. Nice up and to the right? 35.98 billion, pretty much just up every year, minus 2020, and we all know what was going on back then. So profit margins, now their profit margins are up and down a little bit, and over the last 3 years, down from 2021 to 2022, but then back up in 2023. Yeah, companies like this, and a lot of this might be due to, what was going on, the CV19 stuff that was going on here in 2020 forward. So I'm not as concerned. There was a big jump up in 2021, but I would like to see that a little, even a little steadier would be nice. But 11.46% current profit margins, which aren't terrible. EBITDA, same thing, pretty much up and to the right from 2014. You're going to have a couple years down here where we had some issues there. We all know what was going on. Now, dividend yield 2.5%, annual dividend $2.28. Ex-dividend date was May 16th. Quarterly payout ratio 60.96. I think Yahoo Finance called it 58. It's pretty close enough, around under 75% that I'm looking for anyway. Again, another nice dividend growth, 7.69%, high single digits here. 14 years of dividend growth. Buyback yield, so this means they're buying back shares of 1.07%. That's nice. And shareholder yield of 3.56%. So very good numbers overall. Last payout was May 31st here, or is going to be May 31st. They're going to pay 57 cents per share. Gilead Sciences, ticker GILD, out of the healthcare sector, closed out the week March 28th at $73.25 per share. Market cap of $91.25 billion. Revenue $27.12 billion. Net income $5.67. Again, shares outstanding doesn't mean anything to me unless you compare it to, are they, buying back shares? Are they keeping shares the same? Are they diluting you as a shareholder? That doesn't mean anything on its own, in my opinion. EPS, earnings per share, is at $4.50 per share. Price to earnings, now these are more like the price to earnings ratios I like. $16.28 per share with a very low forward PE of $10.11 per share. Dividend of $3.08. That's annual. They are a quarterly payer, so divide by 4, or we'll see it on the next slide. Very nice starting dividend yield on this one, 4.21%. Ex-dividend date was March 14th. Paid out on the 28th. So paid out right there, last day of the trading week here for this one. So again, if you were to buy them next week, you would be in line for the next dividend, but you're going to be waiting several months. 52-week range as low as $71.37, as high as $87.80. 87 cents, I mean. So again, right up against its 52-week low. Beta of 0.2. So this is very low volatility on this one. Analysts call it a consensus buy. Price target of $85.85 with a 17.2% potential upside. Earnings date was January. Wow. Their earnings date was back in 2023. They've got to have another earnings date coming up. You'd need to do some research on that one to see what's going on, but they haven't updated this earnings date from January 31st, 2023, and I find that hard to believe that they're not going to have one in 2024. Let's look at the 5-year dividend yield average, or dividend yield theory, to see if this one is potentially undervalued. To do that, we look at the 5-year dividend yield average at 3.98%. We compare it to its current 4.21%, and since it is higher, that speaks to potential undervaluation. Payout ratio 66.67, again under the 75% I look for, so still some room to increase that dividend, pay down debt, make acquisitions, reinvest back into the company, whatever they're going to do with that free cash flow. Return on equity, return on invested capital, I like 10% or better. They're at 26% for return on equity, 13% for return on invested capital. Very good numbers overall. Let's take a look at free cash flow. Again, going back to 2020 here, they were at $7.5 billion. Jump up to 2021, $10.8 billion. 2022 saw a bit of a down at $8.3 billion, and so far, again in 2023 is 7.4. Might be something to watch with free cash flow, though you can see they are repurchasing their shares as well. 1.5 million there, 546. So not only did they have a good year in free cash flow in 2021, they repurchased a big chunk of shares. And some of this decrease in free cash flow from 2021 to 2022 can be accounted for in the repurchase of stock. Same thing with 2020. Overall, I would say from 2020 to currently, with the repurchase of shares, there is growing free cash flow here. Not a lot, not a lot, but there is growing free cash flow. At a minimum, I'd call it flat. All right, so let's look at Gilead, GILD's revenue. Now this, I'd have to go back in time and see what's going on here. So their revenue from 2015 was decreasing. It has gone back up from 2018 and kind of has been flat the last several years. So overall, I would call at least the last few years flat revenue and not up very much from 2014. I'm wondering if there was a spinoff or something here with Gilead. Anyone who owns this one, let me know what was going on back here 2015 to 2018. Was there a spinoff? Was it just they're decreasing revenue? I'm not sure, but looks like a bit of a drop here a few years back. Like I said, from 2018 to forward, kind of flat over the last several years. So might be something to watch there. Margins, same thing. They kind of followed revenue there, down here in 2018, really went down in 2020, around 20%, which are decent profit margins, but not what they used to be. So again, I'd want to do more research on this one. Same thing with EBITDA, right? Big drop here from 2015 to 2020. Looks like they've started to recover a bit here in 2022 and 2023. Yeah, so large company might be slowing down a little bit. Might be worth watching on this one to see what's going on. Or like I said, they may have had a spinoff or something here that is not shown in the data. You'd have to go in and look at more detailed into the company. Dividend yield 4.21%, very high. Annual dividend $3.08. Ex-dividend date March 14th. Quarterly payout ratio 68.44%, so under 75%. I like dividend growth is slow, 2.72%, which makes sense. The revenue growth is slowed or flattened, so they wouldn't have very fast dividend growth, but you are getting a pretty good dividend yield. 9 years of dividend growth. Buyback yield, so they are buying back some shares, 0.32%, and shareholder yield of 4.52%. Last dividend paid out March 28th was 77 cents per share. And number 4, Vale, ticker VALE. This is a mining company out of the materials sector. Closed out the week at $12.19 per share. Market cap of $52.18 billion. Revenue of $43.84 billion. Net income $18.79 billion. Again, shares outstanding doesn't mean anything to me unless you look at, are they diluting you as a shareholder, buying back shares, or keeping them flat. EPS, earnings per share, sitting at $4.05 per share. Very nice. PE ratio, very low. $6.66 with an even lower forward PE of $4.62 per share. Dividend of $1.42 annually. Now this one is a little tough because they typically pay out 2 times a year. Sometimes they pay out once, sometimes they pay out 3. Pretty typically it's 2 times a year, but sometimes they do pay out 3 times a year, and sometimes they do only pay out once, right? So if you go back in time, you'll see what I'm saying on that. Ex-dividend date March 12th. They did just pay out this past week, March 26th. 52-week range as low as $11.88, as high as $16.60. So another one right up against its 52-week low. I've been buying this one. This one is in my portfolio. Really like this company, and I feel like they're showing a lot of value right now. Beta of 0.93, so they are just slightly under the volatility of the overall market. Analysts call it a consensus buy. They have a price target of $17.09, with a 40.2% upside on this one. Earnings date February 23rd, another one way back in 2023. They've got to be having earnings coming up here in 2024 sometimes. So I'd have to look and see what's going on there. Now let's take a look at dividend yield theory to see if this one is potentially undervalued. 5-year dividend yield average of 3.11%. Current dividend 14.41%. Very, very high dividend yield and potentially undervalued, at least according to dividend yield theory. Payout ratio 66.1%, so under the 75% that I like. Very nice numbers overall for this company. Return on invested capital, return on return on equity, or return on invested capital, I typically like 10% or better. Return on equity on this one, 53.4%. Return on invested capital, 27.99%. Very efficient company here as far as how they're returning their money back and reinvesting back into the company, opening new mines, building out their infrastructure. They do have some shipping as well. It's not just the mining arm here on this one. This is a foreign company out of Brazil. I really like this mining company. Looking at their free cash flow going back to 2020, $10 billion here. 2021, big jump up to $20 billion. And if you went back and looked at 2021, the metals that they mine were very, very high. That's part of the reason for this. 2022 was a drop back down to $6 billion. So far, at least in 2023, or they haven't closed out 2023, it doesn't look like, $4.6 billion. Though you can see they are aggressively repurchasing their own shares here in 2021, 2023, and so far, or I'm sorry, 2021, 2022. They haven't shut out 2023 yet. So very aggressively repurchasing their shares. Now, this is going to be a cyclical company, right? You're going to have ups and downs because the mining companies in general follow the price of metals. When metals go up, they do very well. When metals come down, they do poorly. That's how they are. They're driven by the price of metals, though this one does have, again, its arm in some transportation as well. So they're not quite as cyclical, but still are impacted by the price of metals. This one, I'm buying, and I buy it anytime it hits down in the $12 range. That's where I like it. It's hit there several times over the last several years. I think my cost base is around $13 and some change. So anytime it hits down in the $12 range, I've been buying, and I've been buying this over the past month or so as it's been in the low 13s to $12 range. Now let's look at it. Vale's revenue here, again, very good overall. You can see the cyclicality of that, down in 2015, but pretty much since 2015, nice up and to the right. I like to see that. Profit margins, they've really done well in their profit margins. This is where you can see some of that cyclicality, right? In the negative here in 2015, back in the positive, in the negative in 2019, back in the positive over the last several years. So that's part of that cyclicality of a mining company. Same thing with their EBITDA. You can see that cyclicality overall. So that's not something I'm as concerned with overall from 2013. I mean, it looks like they're about flat, but very, very nice company. In my opinion, this is a sneaky play for me on EVs. They do have some nickel, which is one of the metals that EVs are using for their electric vehicles, their batteries. 11.64% dividend yield, annual dividend $1.42. Ex-dividend date was March 12th. Payout frequency isn't listed because, like I said, sometimes they pay out twice a year. There are times they pay out once a year, and sometimes they pay out 3 times a year. Payout ratio, they're saying 35%. Yahoo Finance had 66%. Either way, under the 75% that I'm looking for. Dividend growth, same thing. This is a little tricky. Right now it says 29.72%, but they don't typically grow their dividend consistently from quarter to quarter or year to year even. Again, it's based on the price of metals, but their last dividend payout last year was much lower than the one that they just paid out, so that's that dividend growth you're seeing. Buyback yield of 5.66%. Very nice number there. They are buying back shares. Shareholder yield 17.3%. That is smoking high. That's really nice. And again, their last payout was this past week, 54 cents and some fractions of a penny. Well, those are 4 stocks that are near their 52 weeks low. You might want to take a look at. Let me know if you have any of them in your portfolio. Are you buying any? Are you holding? Are you waiting for more of a pullback? Or are you potentially selling and they no longer meet your criteria? Would love to hear from you. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Hopefully you have started your own investing journey. And if you have not, let me know why in the comment section down below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So let me know if there's other information you'd like to see in this particular series here that I'm doing, 52-week low. It's not one that I'm going to do every week. I'm just going to do it sporadically whenever I see some stocks that are interesting that are pulled back. Maybe I do it once a month, maybe once every other month. It's not one I'm going to consistently do, like my Stock Pick of the Day videos that I do Monday through Thursday, or my portfolio updates that I do every Sunday morning. And again, tune back in tomorrow, Sunday morning. Happy Easter to you out there. Tomorrow, don't forget to put out some eggs for the Easter Bunny to hide for you. If you have kids, you know what I mean. Well, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Again, thank you for stopping by. Hope you're having a great weekend, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice, counsel, or certified financial advisor.